We all want the world to come on chain, right? There's a lot of stablecoin neobanks that we're working with. You make that card for coffee, it's like $4. Your transaction fees should not be like a percentage basis of whatever that transaction is, right? So like with Solana, right, it's like a fraction of a cent, right? And if we think about like real world use cases beyond just crypto and speculation and trading, like you have to have something that has really low fees.
Hello everyone, welcome to PayFi mini-series. Today we have another amazing guest, Nick van Eck, founder of Agora. Welcome, Nick.
Thank you for having me.
Thank you for being here. Because this is the PayFi mini-series, it all starts with the same question. What does PayFi mean to you?
PayFi to me sort of encapsulates everything around stablecoins and blockchain-based finance as it relates to the payments industry, right? If we think about like why blockchains are even valuable, it's because you can settle 24/7 instantly for very low costs, right? And like the traditional industries where that really positively makes a difference is payments. And so I think today you're starting to see, first it was more crypto forward companies that were using stablecoins to move money faster, cheaper, but now you're starting to see traditional businesses come in and starting to use stablecoins or credit, right, to actually make the whole stack, much more efficient from a settlement perspective, but also from a cost perspective.
That's amazing. I love that you kind of focused on the payments aspect of it, both from a cost perspective, but also from a, accessibility perspective. And we're seeing this PayFi movement growing really fast within Solana. With Huma, obviously, we launched the first version of the product on the EVM, and then 2.0 we decided to go on the Solana chain. One of the things was the active user base, but another thing was just so clear that while the stablecoin liquidity is being more fragmented on the EVM side, it's being more consolidated and it's growing at a faster rate on the Solana side. And you guys also launched, the AUSD on Solana.
Yeah.
How did you make that decision?
Yeah, I think for us, we think very deeply about the ecosystems where we're going to go. And for us, it's both a quantitative decision, but also like a subjective decision, right? And so obviously Solana has the users, TVL growth, but from a subjective perspective, we kind of dig a little bit deeper and say, can this ecosystem scale? Is the foundation and the team going to be here for 10 years? Are the ecosystem teams here for the right reasons, right? And we found that all to be the case with regards to Solana. And so we'll probably have native deployments on, I'd say maybe 10 or a little bit more sort of like open, permissionless ecosystems, and maybe some native deployments on more permission or corporate environments. And Solana to us is just obvious, right? The users are here, it's growing. And we've also deployed on a few other, non-SVM, low cost, high throughput L1s and L2s. But Ethereum, I was actually chatting with someone about this earlier today. I would say I'm bullish on EVM, but bearish on Ethereum. It's just not in any shape or form an application layer anymore. I was using an anecdote. A friend of mine launched a new application, and so I was moving some stable coins around and did 3 transactions on ETH. This was about 6 months ago in October, and it cost me $50.
Oh man!
And it's like that's ridiculous. And it's like if you're moving at $10 or $20 or even $1,000, like that is like a material portion of that transaction, right? Like
that's right.
And so from a first principles perspective, Solana I think is one of the ecosystems that is set up to really succeed because the performance is exceptional and it's low transaction fees.
Yeah, that's actually really changed the user experience for us as well. So on EVM, our minimum deposit had to be pretty high. Right. For people to come in and provide stablecoin LP, and that was mainly the reason for like small deposits don't really make sense on EVM because even if you're like on a very efficient chain, it eats up quite a bit. But on Solana, we made it $1 minimum deposit, and it's an easy decision because with the transaction fees, even if somebody wants to put just $1, it makes sense.
Well, and even if you're like a wealthy individual or a wealthy entity, like. If I just think about my transactions on a weekly basis, right? If we all want the world to come on chain, right? There's a lot of stablecoin neobanks that we're working with, and like I'm very enthusiastically supporting just because I love crypto and blockchain-based finance. But you make that card for coffee, it's like $4, right? And so like your transaction fees should not be like a percentage basis of whatever that transaction is, right? like a large percentage. And so like with Solana, right, it's like a fraction of a cent, right? And
that's right.
And so if we think about like real world use cases beyond just crypto and speculation and trading, like you have to have something that has really low fees.
That's right. And previously you mentioned that numbers are growing, and both on the user side, also on the stablecoin TVL on Solana, and something crazy is also happening. I'm sure you realize this as well. The stablecoin volumes and the TVL is growing at a rate that's disconnected from the market itself.
Yeah.
Why do you think this is happening? And where do you think it takes us? What does it mean for the future of stablecoins?
Yeah, so I first bought a Bitcoin in 2016. So I've been in crypto for a long time. And I like to say now that I feel like we're in inning number 7 of speculative crypto and in inning number 1 of like real crypto. And what I mean by that is just non-speculative adoption. And so these rails are valuable because you have instant settlement and low transaction costs, right? And that is really, to me, the back-end innovation that financial services companies and payment companies never had, right? You had fintech over the last 15 years, but it was primarily demand aggregation, right? So like, let's take in Stripe, for example. They're using all the same existing payment rails, right?
Exactly.
But what they did is they expanded, the opportunity set for merchants to, not just serve customers in New York, but also New Jersey and, Turkey or Europe, right? And so that was great, but you also had neobanks like Chime, right, where they focused on a specific user segment, but again, using the same old rails. And so now with blockchains, you're finally having that back-end innovation, so faster settlement time, higher capital velocity, and that matters to all these real-world businesses. And so I think we've gotten to a point where payment companies, many of whom are cross-border payment companies, have just found stablecoins to be a much better option for a variety of reasons, right? You have faster settlement, it's cheaper, and you're actually having better rails with certain different currencies now. And so I think, what got us to sort of today was centralized crypto trading. Like that's why Tether really, grew in the first place, as well as like some EM dollar demand. Yeah. But now we're seeing demand for stablecoins come from a variety of different sources, like cross-border payment companies, trade finance, institutional finance coming on chain. And so that's why we started to see this divergence of, crypto market cap may have been going down the last couple months, but stablecoin growth is still going up. And I think you're going to continue to see that for the next, 20 plus years.
100% agree. So a lot of times people, ask me about, okay, we're building this PayFi stack and we're trying to make sure that there's a lot of orchestration happening between different layers of the transaction layer and the stablecoin layer, custody layer, compliance layer, and the application layer. And obviously the stablecoin layer is growing faster than anything else. And people are sometimes confident, okay, like what does the future of stablecoin look like? Should we have actually, 1 million stablecoins? Does it make any sense? And also people tend to think about stablecoins in this, I think, very simplistic terms of there's a stable coin, and then there's decentralized stable coins, and then there's the yield-bearing stable coins.
Yeah.
To me, that doesn't make too much sense. I understand the centralized versus decentralized aspects because one depends on banks and bank-like custodies and treasuries, backing it. Decentralized, more independent than that. I understand that divide, but I don't understand the stable coin versus yield-bearing, because it doesn't necessarily change things too much in terms of what is being used for. Yes, there are clear use cases for what you can do with a yield-bearing stable coin, but it's more important to look at where does the stable coin itself focus on to drive the demand.
Yep.
Where does it focus on in terms of use cases to build its ecosystem? Where does it focus on to build out based on all the entry and exit points, right? So how do you guys think about this at Agora? Because I know that you're not thinking about Agora and AUSD as a simple stablecoin. You're thinking about a full stack solution for certain use cases you're focusing on, cross-border being one of them.
So the reason that we designed our model the way that we did, and so maybe winding back the clock, I spent my whole career as a technology investor and was looking at the market, and it was very clear that stablecoins were, to me, going to hit 10 to 20 trillion, in the next decade or two. And you had a duopoly where neither of those parties were particularly customer focused, both from an economic perspective, but also from just a customer service perspective. It was very challenging to reach both of those issuers. If you were a business using them, you were obviously cut out of the economic equation. And to me, all these businesses globally are the ones that are driving the utility and liquidity of these assets, right? And so what we wanted to do is figure out a way to enable those businesses to be in the economic sort of flow, while also enabling maximum utility for the stablecoin. And so that's why we designed AUSD to be one-to-one. So that means it can be used in payments, cross-border, where there's many different regulatory rules, right? And then also on centralized exchanges, because it's very clearly not a security. If you're yield bearing, you're a security. There's no like gray area in crypto, although people like to pretend. It's very black and white. And so if you're a yield bearing stablecoin, Paxos has USDL. It's not allowed in the United States. It's not allowed in Europe. It's not allowed in Singapore, Hong Kong, and the list goes on. And so that's like 60-70% of global capital markets. Yeah. And so if you're trying to build a stablecoin that is used cross-border, it has to be one-to-one. And so for us, we're focused, I would say, on a number of different areas. Of course, have built a good chunk of share in DeFi and like sort of on-chain liquidity, because that's important to us. And are starting to really now focus more on cross-border payments and as well as institutional finance. And there's a number of different things you have to do there, right? So we're in Turkey now, so let's talk about Turkey. We spent the last few days meeting the local exchanges and the local payment companies. Mm-hmm. And so names that you're very familiar with, like Parabu or Papara, and like you have to build deep relationships with them and get to know those teams. And what's attractive to them is being able to solve problems for their users, right? And one of that is just having access to dollars. The other is actually maybe having some of this income flow back to the users. And so that's sort of like one piece, right? Is building localized connectivity with the local exchanges and then also the local fiat, right? And so setting up those lira pairs, because that's really important. And obviously in Turkey, FX is very important. And so building those relationships, working with OTC desks, market makers. We just got listed on BitHub in Thailand. We were the first stablecoin to be listed in 5 years. And so like that's a very big focus for us. Other pieces of the stack that's important. And I actually heard this, and hadn't thought of it until just hearing it so many times, is we were talking to all these payment companies and they said, yeah, capturing some of that float income is great, but can you give me credit? And for the first like 6 months, I was like, I can't give you credit, I'm a seed stage company, right? And what I've realized is so important is, even if folks are using stablecoins, they're still connected to the existing system. That's right. And we are dreaming of, I think, a world where everything is on-chain, right? But that's just not the case. And it won't be the case for, probably 15, 20, even more years, right? There's still going to be these existing rails. And so even if you're using stablecoins to move money cross-border, you're going to still have, or value, let's say, you're still going to have gaps in settlement times when you're moving things, from, let's say, a dollar stablecoin to like Mexican peso fiat. Because
you have a float you need to manage in dollar fiat. You have a float you need to manage in stable coins. You have a float you need to manage in pesos, right? It's like all of those you need to manage separately.
and this I think is where you guys come in handy, right? As you provide working capital to many of these non-speculative businesses that are using stablecoins, right? And so that's like another important piece of the stack. But yeah, I think holistically you have to work with local partners if you want to be a global issuer. Personally, I think there'll probably be 5 to 10 big global issuers. You obviously have Tether and USDC today. I think you'll probably have 2 to 3 more that are much more aligned with the businesses and the geographies that they work in. I think the benefit of working with us is we have like a very global view. Like, to me, it's just so obvious that the value of stablecoins is outside the U.S. And I think actually many of our competitors, like for some reason, don't get that. And so actually a number of employees from those companies are coming to work for us because they work in Singapore, or they work in Turkey, and they're like, hey, like we very much see like that our view on the world and managements is misaligned, right? So like I think being global first is important, and that's what we're trying to be.
That's amazing. Actually, one of the first things we decided on as Huma was to be a global company or a global project, in a sense that if we want to solve the problems of payments and PayFi at a scale that we wanted to become one of the locomotive drivers for this $1 trillion, $2 trillion, $10 trillion world that we're going to get to in a decade or so, you have to be at every single payment hub. And when you start seeing that, obviously New York is a payment hub as well, but when you start seeing what's happening in Hong Kong, what's happening in Istanbul, what's happening in Dubai, what's happening in London, when you start seeing all those different hubs and where the money is moving, you realize basically that the problems are so much more massive and the demand is so much more massive in the emerging world than it is in the US. I think for that reason, some of the best founders are the ones who actually understand that world and actually are putting a lot of their effort into making sure that they are capturing the demand in that world by solving their problems, and then we're seeing those companies rise up much faster than others. As we close it, what is kind of like your bullish case for PayFi ecosystem if you look ahead like 5-10 years, because we're obviously very, very early, right? We're just like opening new doors on the regulatory side. We're just like getting all these local partners comfortable, like you're working on one end, we're working on the other hand, trying to be everywhere to educate them in terms of like how they can solve some of their existing challenges, utilizing this new technology and rails and new partners. But there's still a lot to go through, and things will look very different in about every step of the way. But when you look ahead like 5-10 years, what do you see? What's your like most bullish case for PayFi?
Yeah, so I think I would kind of break it down into maybe 3 stacks, right? So you have the stablecoin, you have like the transaction layer, which could be on-chain or off-chain, or the movement from on-chain to off-chain.
That's right.
And then credit. So from a stablecoin perspective, I think 2030 will be probably around 2 trillion in stablecoins. I think that'll probably be, maybe the top 5 issuers will have about 1 trillion of that or more. And then, on the transaction side, I think, there's a lot of money to be made, at least today, in, the exotic off-ramps. What we're trying to do with a number of our partners is try to bring dollar off-ramps to zero, because they're called digital dollars. And it's like kind of like, going back to when I started the company, I was like, it's ridiculous that people are charging 50 basis points to go from, a stable coin to fiat, like USD fiat.
Doesn't make sense.
It's egregious. And I think those, the companies that are doing that won't be successful over the long term because they clearly don't prioritize customers. And so, I think the USD rail from a transaction perspective will be less attractive than, maybe some of these other foreign currencies. And then on the credit side, I think it's going to be enormous, right? Because there's so many companies and industries around the world that'll benefit from faster settlement time. So we chatted about a few examples, but like one really, a simple one is I was talking to a firm in Hong Kong, and they were funding a new investment of theirs. And it took, international money transfer. It took 10 days to hit the account. And then it actually got rejected because the name on the account was, I guess, too long for the field. There was some mismatch. And so they had to send it back. That took like a number of days, and then they had to redo it. And so the whole process of sending, it was $10 million. This money took a month. It's like, use stablecoins, that's done in a minute. You go back, you go on with your life. But I think the facilitation, and of working capital for these different pools and these different types of businesses will be quite large, right? And so I think maybe, on a opportunity basis, 2030, how much do we have in stablecoin credit? It's tough because you get a higher velocity on the capital, but maybe like 25 billion or more. So
that sounds about right.
Yeah, I think it's a good opportunity set.
That can actually generate $1 trillion volume easily over the course of a year.
Yeah, and you generate high APYs on that. Nice double-digit APYs, and I would say it's uncorrelated. It's relatively low risk.
Yeah.
And so I think it's like kind of a new asset class that's been created by stablecoins, which obviously you guys see too. So.
Yeah, that's definitely where we're focusing on. It's amazing to have you.
Yeah, thank you for having me
on this mini series, and thank you for being with us today.
Yeah, thank you.